Investing in index funds is one of the best and easiest ways to gain wealth and grow a sizable portfolio basically on autopilot. Even Warren Buffett, one of the greatest investors of all time, swears by index funds. So in today's video, I'll be walking you through step by step, showing you how to invest in index funds, including what exactly index funds are, key criteria to know before purchasing, and how to build a portfolio consisting of different index funds. So let's get started. An index fund is a basket of securities that allows you to invest in hundreds and sometimes even thousands of different companies just by purchasing this one fund. So an index fund allows you to easily diversify where you keep your money without having to go and individually purchase shares from each one of these different companies. An index fund gets its name because the main objective of the fund is to match the returns of a specific market index. So the index fund may be trying to match the S&P 500, the Dow Jones Industrial Average, the NASDAQ, and so on. Instead of having fund managers who analyze companies and make a decision of where to invest, index funds are run more on autopilot because they are automatically set up to match the exact holdings of the benchmark index. So this essentially means that an index fund is passively managed. Before you set out to purchase an index fund, there are some key criteria you should know to make sure you're making an informed decision. Number one is the expense ratio. The expense ratio are the annual fees an index fund pays for portfolio management and other administrative fees. And this expense is passed on to you, the investor, and it is skimmed off the top of your investments annually. And the expense ratio can range anywhere from 0%, for example with the Fidelity Zero Cost Index funds, all the way to around 0.5%. But obviously the lower the fee, the better, because it'll save you money in the long run and your investments can grow even more exponentially. The typical index fund expense ratio is around 0.2%, so you'd want to look for funds around this range and even lower. Number two is the investment minimum. And depending on the broker that you're working with, some index funds have a pretty high investment minimum, like this Vanguard index fund VFIX, which has a $3,000 investment minimum. But if you choose to go with a broker like Fidelity, most of their index funds have a $0 investment minimum, which makes it really great for beginners. And personally, this is one of the reasons why I have chosen to use Fidelity for my investments. Number three is transaction fees. Transaction fees are the money that you pay when you buy into or sell out of an index fund. And the fees really depend on the fund itself because some funds may only charge you to buy into the fund, other funds may only charge you when you sell, some may charge you to do both buying and selling, and some may not charge you at all. Number four is dividend reinvestment. So throughout the time you're investing in an index fund, you may receive dividends. To maximize your return, especially if you're investing for retirement, you'll want to make sure that you're automatically reinvesting those dividends rather than just keeping the cash. And just take a look at this chart here, which shows what your returns would look like if you reinvested dividends versus if you did not, and that difference is vast. To have the option to automatically reinvest in dividends, you'll want to make sure that you're selecting an index fund and not an ETF. Index funds have the option to automatically reinvest dividends, while this is not always the case with ETFs, especially if you're using major brokerages like Vanguard or Fidelity. So you'll want to make sure that you're paying attention to the details and choosing an index fund and not an index tracking ETF. Now I'll give you my personal opinion on some of the best Fidelity index funds, but I do want to emphasize that this is just my personal opinion. I'm not giving you financial advice, so you can take what I'm going to present to you and do your own research as well. Number one is FXAIX, which tracks the S&P 500 index and has a low expense ratio of just 0.015%. Number two is FSKAX, which replicates the Dow Jones index and has an expense ratio of 0.015%. For international stocks, look into FSPSX, which has an expense ratio of 0.035%. FXNAX is Fidelity's bond index fund, which has an expense ratio of 0.025%. If you're interested in real estate, look into FSRNX, the Fidelity Real Estate Index Fund, which has an expense ratio of 0.07%. And I'll leave links to all of the index funds that I mentioned in the description box below so that you can look into these further. Now that I presented all these different index funds, you may be wondering how to allocate your money amongst these index funds. And when it comes to building out a portfolio, it can really be as simple as you want it to be. A very classic strategy for building an investment portfolio is called the 3-fund strategy. Just like the name suggests, you would select 3 index funds, one that tracks the US stock market with both large and small stocks, one that is an international stock index fund, and a third one that holds government and corporate bonds. How much of your portfolio you allocate to each one of these 3 areas depends on your preference and also your risk tolerance. But generally speaking, the longer you have until retirement, the more money you should consider investing in stocks rather than bonds so that you can see a larger return on your investment in the long run. And then as you get older and closer to retirement, you would want to shift to a more conservative strategy by moving your money into bonds, because bonds tend to be more stable and have a more predictable outcome than stocks. To give you an idea of how much to allocate between stocks and bonds, general guidance suggests that you take 100 minus your age, and that is the number that you should invest in stocks. So for example, if you're 30 years old, you take 100 minus 30, which is 70. So you would invest 70% of your money in stocks and the remaining 30% in bonds. And by the way, this is just one way to build an investment portfolio. It's certainly not the only way. So if you want a separate video covering tips on how to build an investment portfolio, then just comment down below and let me know. Now that you have an understanding of index funds, I'll show you how to actually purchase the funds on the Fidelity website. So once you're logged into the Fidelity website, on the homepage you can come up here and type in the ticker symbol of the investment that you'd like to purchase. So for example, FXAIX. Then from this page you can come over here and click buy. Then it asks you to select the account. So select the account you'd like to invest it in and click go. And then from here, what you'll need to do is click on this drop down for action and select buy. Then enter in the dollar amount that you'd like to purchase. Then you'll preview your order. And if everything looks good, then you'll say place order. And then you're done. After that, you have officially invested in an index fund. To automatically reinvest dividends, you'll want to come over here and click on more, then click on account features. Then you'll want to come over to the section that says brokerage and trading and hit the drop down arrow and select dividends and capital gains. And then from here, you'll see that the default is set to deposit to core account, but under action, you can click on update to change that. And then here, you'll just want to select this box here for reinvest in security. And you also have the option to apply it to all mutual funds that you're holding and future mutual fund purchases. If you would like that, you can check those 2 boxes and then you'll just click update. And there you have it. It's as simple as that. And now you can pretty much build wealth on autopilot. And if you want more investment knowledge, then click the video on the screen to hear about the differences between index funds, mutual funds, and ETFs, because a lot of people use these terms interchangeably, but the truth is that they're not the same. So check that video out, and I will see you next week.